Numbers should always add up. But when you look at it that way, there's only ever three things you have to do when you look at the world this way, right? One, increase the value of your assets. Number two, manage the liabilities and the debts. Manage them. I'm not saying don't have any, because sometimes you need it, but manage it. And the other way is earnings. These are costs you're going to incur, are not part of the direct labor of doing the job. If you don't have your benefits and you can't be seen, if you got sick or got hurt on the job, maybe you have an office, a car, you might have software. They're all somehow related to the business's operation. I might call it general administrative. I might call it operating expense, or I might call it, overhead. Borrowing money is not the same as earning it. That's something I see people make that mistake all the time. Another mistake is agreeing to do things or pay for things before they actually know either where the money is coming or before they have it. Consider that we don't call your operation a company for no reason, right? Like it's the company you keep. It's supposed to be a team, whether it's the people who go out and do the work or whether it's the people who support the work getting done. It's all team.
Hakim, welcome.
Sir, it's great to be here.
Likewise, thank you so much.
No problem.
So you help businesses with their accounting, and you are an accountant, CPA.
I am a fractional CFO.
Okay.
What that means is, I'm a chief financial officer. That's my training. That's my background. And people can buy a piece of me, hence fractional. Right. So rather than going to the expense of hiring me for 24/7, we do projects at the scale and at the pace that people can afford and that they need. All right. So that's what that means. But no, I'm a financial accountant by training. I'm not a public accountant, right? That means I've spent my career doing financial planning and analysis. I started out in the banking sector, so I work with capital structure, whether it's a loan or it's an equity investment. I negotiate and structure those, and I help entrepreneurs become fluent in the language called capital and finance, right? So that when they are doing what they're best at, they're never losing a grip on the capitalization of their company. So they don't run out of money, and they don't misspend what they've got, and they know how to plan, grow, and develop. So
and
that's what I do.
It's super important, I think, especially when you start out, because when I started in 2009, luckily my previous employer had taught me cash, debit versus credit, right? The terminology such as reconciliations.
Oh, yes.
The stuff like that, and expense coding. So I was lucky. I think it was a head start for me.
You definitely were ahead of the game.
There are so many entrepreneurs just dive into it because, especially cleaners, let's say I clean great and now somebody wants to pay me directly and I have a handshake and sometimes not even a contract, and then I dive right into it and I take money from them and I proclaim that I have a business just to find out that I get hit with like taxes, the other expenses. So introduction to financial basics. For someone just starting out in cleaning business, what are the essentials do you think steps they need to take from the get-go?
Well, I think there are two levels. Okay. One level is to cultivate an understanding of how we look at business. Yeah. The second is to know the basic actions you have to take and some of the things to stay away from. Right. So in the context of the basic understanding, what I often introduce my clients and my students to is life through the balance sheet, right? Which not everyone gets introduced to at first, but I say, look, the basic accounting equation is assets equal liabilities plus equity. And okay, that means the stuff you've got, all right, is equal to who you owe and what you own, all right? And those numbers should always add up. But when you look at it that way, there's only ever three things you have to do when you look at the world this way, right? One, increase the value of your assets. Okay, and there's a lot of ways you can do that. Right. Number two, manage the liabilities and the debts. Manage them. I'm not saying don't have any. Right. Because sometimes you need it. Yes. But manage it. Pay attention. Track it. And the other way is earnings. Now you can increase equity by putting more of your own money in or having a partner, but really, if you're earning the money, in other words, your revenue minus your expenses gives you something left at the bottom, and you're tracking that, then you're also going to build your equity and grow the asset value. So that's a lot of words to say, pay attention and track things, right?
Yes.
The second level is to take specific actions, right? And I think one of those actions is to be aware that in this country, you can wake up one day and say, I am in business.
Yes.
And everybody's going to believe you.
Right.
You don't have to go buy a mothballed business entity and clean it up. You don't have to get a special this. You can wake up and say, I'm in business, right? Which means you need to act like it, right? Which means, number one, do not commingle your funds. Like,
I see. Personal and business, keep them separate.
Yeah. Whether you have gone ahead and incorporated your separate entity or not, whether you have a separate bank account or not, you need to, from day one, start to think, now I've created this thing that exists called a business.
Yes.
It's got its expenses, its revenue, its banking, its stuff, right?
Right.
It is not me. And the sooner you think about that, the more you can work on it and build it, right? If you mix it all up, then you're going to find out real soon that it's like, wow, you don't know what was your grocery money from how much you're supposed to set aside to pay your business bill from how blah, 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 blah.
Yeah, it can get very expensive.
Yeah, because you're going to make mistakes, and mistakes are expensive.
What if it's somebody like me had literally no money when I started, but let's say I have a personal account, and now I just got 2 people or 3 people that are starting to pay me. So if I don't have enough money or knowledge to open a free business account, which actually is free, you should be able to just go and open it.
Sounds pretty good to me.
But let's say if I didn't have that,
just
creating a separate account, at least, is that something? Is it better than nothing, or that's like completely not advisable?
Well, let's separate the psychology from the reality.
Okay.
All right. You start day one and you haven't been to the bank and you don't have a separate account and blah, 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 blah. That's fine.
Yes.
Take a piece of paper. Okay.
Yeah.
And you really simple say, my money, business money, and you just track it.
Okay.
Or if you got a spreadsheet, just track it. You don't need to have an account to track it. That's the psychology. All right. So if I took out a blank piece of paper and I just on one side said, all right, I have $100. All right. 75 is for my family.
Yes.
On one side of the page. 25 is for my business. Well, there you go.
Right.
Are you going to spend 30 on the business? No, I don't have it for the business.
I see.
Right, do you have $100 in your account? Yes. Could you? Yes. But now you've already,
Unless you figure out how to get more money from outside
you
for
make
the
a
business.
conscious decision.
I see.
Right? If I need to spend 30, I'm going to move $5 from my family column to my business column.
I see.
All right? So now I've already started to build the psychology of the business as something separate. I didn't open an account. I didn't do anything fancy. I just tracked it.
I see.
Yeah.
And this a perfect segue to the mistakes that cleaners do. So one is commingling accounts.
Yes.
Is there other things that you see that small business owners, especially in services industry, do or don't?
I think so many of us who are good at something, right, make the mistake of thinking that we're therefore not good at other things. And we see this all the time in finance. People say, oh, I stink at finance. I don't understand. No, you do. Okay? So I think one mistake is feeling insecure where you're not actually, you just need to take the same common sense that makes you so good in what you do into your money. And it'll go a very long way. All right? I think that said, there is some language that helps people to stay out of trouble, right? And the sooner you get that language in your mouth, the sooner you will avoid making mistakes, right? Borrowing money is not the same as earning it.
Okay.
That's something I see people make that mistake all the time.
Right.
I got a credit card and I needed stuff for my business and I went and okay, well, that is okay.
Yeah.
If you pretty sure you can make that money back, right? If you can't, you got to be sure you can at least pay the monthly interest or something.
Right.
But don't think that was like you earned it.
I see.
Because you didn't. Right. Another mistake is people agreeing to do things or pay for things before they actually know either where the money is coming or before they have it. All right.
Like buying a $15,000 worth of equipment before you even have a project?
Yeah, I've had folks, say, I'm going to go buy this car because I need it for my business.
Yes. And they still don't have a single customer?
Yeah, I have a single customer.
I see.
But they got a car and they got a loan and now they got a car payment and they got to pay their insurance and all these other costs and it's like, well, did you really?
Yes.
Maybe there was a creative way. Because look, if you can think it up, you can you can do a deal, you can figure it out, you can negotiate, right? So maybe you borrowed that car, or maybe you did something in the middle, or carpooled, or shared, or did something along the way before you went and incurred this big cost that now you have to pay and you don't know how you're going to get out of it. So I see people make that mistake all the time.
The great example would be that one of the things that I teach actually on my SBDC classes. Go get a credit line, but that's not for you to buy your BMW or Tesla,
no.
or also not to buy your scrubber machine, which is $15,000, because you're thinking you're gonna get some grocery account, like commercial groceries to maintain. If you don't have an account, why, right? Once you have it, you can lease it, as you said exactly, borrow it for a time, and then you have enough time even before the contract starts to figure out how you're gonna get the equipment. Just go get the contract.
Plus, which is a great point. I'm glad you teach that, because that's extremely important, knowing when to make those choices. Chances are, if you have the business in hand but don't have the equipment, whoever is financing you is going to be very interested. All right? If you don't have the business and you want to get the thing, they're going to default to your credit score or how much cash you have in the bank, because they're not actually interested in lending or investing or whatever money with you, because you don't actually have any business. All right? So it makes some people nervous to go out and sell business that they don't have that piece of equipment for, they don't have that tool for. But sometimes that's the smartest way to do it, right? There's a lot of businesses I've seen where if you had the purchase order in hand, then you can get the financing.
It's easier.
Much.
Because now you're showing that you have income. You're actually a business.
That's right. That's right.
So America has a blessing and a curse.
And
that's availability of easy credit money. So in my opinion, it's a blessing, but it can be detrimental to your personal circumstances if you misuse it. How do you teach people how to use a cash flow, how to manage it, how to balance
how
it?
much time do we have? There's a short answer and there's a long answer. So let's start with the short answer. The short answer is you use credit as is appropriate for the asset being financed. What did he just say? Which means you're going to match the type of credit to the type of thing being financed. So again, looking at the world through the eyes of a balance sheet, it's like looking at a football field. In fact, when I teach my courses, I start with a football field, right? Because when you look at a football play, a lot of us think gridiron, right? And we can see all of the little markings, and we see the end zones, and we automatically know what happens in the end zone, what happens midfield, and we just by having that one picture in our minds. Balance sheet's the same way. Look at a balance sheet, I know the top is liquidity, it's liquid. I got cash, I got my accounts receivable, things that are gonna happen very quickly. And as I get down to the bottom on the asset side, the things that aren't so liquid, like a building or a car, right? On the capital side, it's the same thing. It's liquid. Like the things I have to pay off quickly, my credit card, my accounts payable, my accruals, the part of my long-term debt that I have to pay within 12 months. As I go further and further down, it gets more, less senior, and things that will take longer, like my mortgage, right? Then my equity, right? Okay, you want to match these things. If I have a short-term need, you're going to fund it with short-term money. If I have a long-term need and long-term asset, I'm going to use longer-term money. People get in trouble in corporate finance and business finance when they mix it. Why? They borrowed short-term money for something that's going to take a really long time.
I see.
Or they have something that's got to get paid right away, but they borrowed a mortgage to pay for it. And it's like, that doesn't match, right?
So the good example would be if I'm a residential cleaner and I work and I'm in a seasonal place, right? Just in the summer, I make, let's say, $10,000 a month, right? Now I think that I'm going to be making the same amount come winter, but which is not true, right? Because then the income drops.
Right.
So based on that $10,000 I'm making, if I go and afford some bigger long-term purchase, then that's not wise.
No.
Because come winter, I'm not able to uphold my financial
that's
obligations.
a good example. That's a good example. I want to come back to that one because you've actually got 2 or 3 things going on there that are really important for cleaners. So you're speaking to seasonality. One of the things that I want to divert on is what you're really talking about is working capital. All right, so that's a term that gets thrown around all the time. People don't know what it is, but you could think about it as the balance between my current assets and my current liabilities. So people owe me, I owe people.
Right.
Or if I owe more people
Yes.
than owe me, I have negative working capital, right?
Yes.
If I have more people owe me than
Yes.
I owe, I have positive, right?
Yes.
Now I still got to collect and pay and extend one and accelerate the other.
Yes.
But this dance between current assets and current liabilities, it can make or break me. Why? I go out, I book more business. Like maybe it's a seasonality
Yes.
thing like you're talking about, and I have customers going to pay me on net 30 terms. Great. I go out, I do all this work,
Yes.
got to wait a month to get paid.
Yes.
Yeah, but now on my current liability side, I got to pay my people every week.
Yes.
Where am I getting that money?
Right.
Where do I get the money to pay people that I need while I'm not being paid?
Right.
Well, probably some short-term line of credit or credit card. If I
see.
use that short-term money like
To
that,
balance it.
I pay that out, and then when I get paid, I paid it down.
Right.
All right? And I dance in and I dance out. All right? That's the first thing I heard in what you said. The second thing is the seasonality. Now that's tricky because seasonality can last literally a whole season.
Yes.
All right? Do I borrow against that? I wouldn't. I would budget against it. In other words, I'd lend the money to myself.
Okay.
I would project out in a simple way. How much am I going to need, like a squirrel, to get through the winter, right? And I would calculate that out as a percentage and just take out that little percentage every time I get paid.
I see. It's kind of like if you're 1099, right? You're collecting the money.
Yep.
And then when you hit with taxes, if you didn't put out a percentage,
It's
then
the
you
same
have
concept.
to write the big
It's
check.
the same concept, except it's my insurance policy against the lean months.
I see.
All right, so if it's 20%, I'm just putting it and I'm forgetting about it.
Right.
I'm putting it aside,
Right.
So now the lean months come, the revenue comes down, and I got something, Seasonal businesses are really a challenge that way.
I see. Like lawn care, right? For example, in the state of Maryland, you've got a lot of work, and if you don't do snow removal, even if you do snow removal,
Lawn care, landscaping.
there's no snow now.
Yeah. Anything that depends on good weather is going to be seasonal. Some kinds of construction,
Right.
they're all seasonal.
Right.
Flip it around. A lot of retail is very seasonal.
That's true.
Like a lot of retailers end their fiscal year in January, which is odd, but why do they do that? Well, because they have all the holiday sales to add up, right? So, they hire seasonally, they fire seasonally, they buy inventory seasonally. It's like a whole thing. Fashion business, very seasonal. So
we have that too in the cleaning business. If you're in construction, post-construction cleanup, that's the whole field, right?
Absolutely.
So construction heats up in summer months when it's warm, and it cools
down. No pun
down.
intended. It cools down in the winter. Does it really? Cools down in the winter? Okay. That's cool.
Right.
Yeah.
So now that I have that money, what are the things I should be thinking about, like when the tax season comes? So imagine, let's say I'm the guy who just started my cleaning company. Up until this, I was on W-2. When I was on W-2 with my previous employer full-time job, all the taxes were deducted. So all I had to do, go to any tax software, put income versus expense, it would spit it out, right? I did not need a CPA.
Yeah.
So now that I'm putting that money as a business, what are the tax considerations I should be thinking of come actually next year?
Yeah. So right off the bat, I need to make a disclaimer, which is that I am not a tax person. This is not tax advice, and in no way, shape, or form
And
should anyone take anything that I say as tax advice. My best tax advice is to get a team. All right, that's the first thing I'll say.
Define team.
Once you decide that you're in business, consider that we don't call your operation a company for no reason. All right, like it's the company you keep.
Yeah.
All right, it's supposed to be a team.
Yes.
Like every layer of your business is a team.
Right.
Whether it's the people who go out and do the work, or whether it's the people who support the work getting done. It's all team. So part of what you need to do as an entrepreneur, as an owner, is figure out who is on my finance team. Okay. Because they speak a common language, but they don't do the same thing. All right. So for example, you might have a bookkeeper, right? You might have a finance guy. You might have an insurance person. You might have a CPA. You might have a tax advisor, right? And they're all different. All common language, but all different. Your bookkeeper is going to make sure that the basic records are high integrity. Okay. What does that mean? It means when you're looking at your profit and loss statement, that it's actually accurate. It's all reconciled to your bank, and that every account in the general ledger is full of true data. Okay, your finance person will look at that and say, okay, we have too much debt. You know, we need more, you know, of something else. So let's manage these assets differently. Let's consider a different depreciation schedule. They're going to figure out what the overall health looks like. Your insurance person is going to say, well, given the business that you're in and the size of the business, you need a different kind of liability, or you need a different thing, or we need a key man life insurance policy, or, you know, let's get these automobiles insured. You know, same language, different cut. Your tax person is going to say, okay, given that you're an LLC, let's consider that we actually have you file as an S corp and save this kind of money and you know, it's all, you know, a banker. You need to start talking, whether or not you do business with a particular, you need to start talking to people, because someday you might say, hey, did that check clear? I need to know, you know, or my online banking's not working, or hey, why don't you come on out and support this cause that I, you know, like real banker who you can call up and talk to. So they're all part of your finance team. The best thing you can do to get your taxes straight is have that finance team, right? As a finance guy, I talk to people's tax advisors because they need me to create a cash-based statement, for example, so that they can get the taxes filed. I need to know what they're doing for the depreciation schedule, so that what I'm putting on the financial report is at least a close match to what they're doing on the tax report.
If I'm a John who just started and I'm picking up $150 houses and I'm cleaning them myself, I can't afford just yet.
That's fine.
All those professions.
No.
Where would I start?
So I'm putting it out there to the guy who's just starting with his cleaning business. You need to start thinking about it today.
I see.
Because as you're thinking about it, you'll see at the right time, it'll present itself. If you're never ever thinking about it, you're going to get so far into what you're doing.
I see. You'll never catch up.
It'll be too messy, right? So the action you can take day one is to set up a bank account of some kind, you know, with an institution that allows you to track the data. All right? What do I mean by that? It used to be people like me, your tax people, you get to the end of the year and people would bring us a shoebox full of receipts.
Right? And we'd be like,
oh my God, now I gotta go through all this stuff. You don't have to do that anymore. Your bank tracks your expenditures.
Yes,
and will even tell you where you spent it and who the vendor was. That's a lot of data. All right? Some banks aren't as good at that as others. I found a couple, I won't name any names on your broadcast here,
of course,
but who are really good at identifying, you know, what you spend it on, putting a category on it. You can download that, you can just look at it on a screen, and it will already start telling you something about how to think about tracking your business. All right? That's where I would start. You know, some great online banks that just, the next thing is if you have to use credit, you want to use a credit card that does the same, that tracks and categorizes the data so that you don't have to. All right? That way, when you can afford a bookkeeper, they're not that expensive, right? They're already working with data that has some contextualization, right? It's not like they're starting with a shoebox full of messy receipts and don't even know when and where and what and how. The data already has some categorization to it, so it's easier now to put together your statement. I think the last thing you want to do is start thinking as a business owner that you want to look at financial reports. So many people don't want to look at financial reports. They're like, I'm not good at that. Stop it. No, you're great at it. It's you. It's just showing you what you did. Okay? It's like looking in a mirror. Would you go to a fancy event, black tie, and not look in the mirror before you walked out? Of course you would. You want my hair? The financial statement's the same thing. It's showing you how much did you bring in, how much did you pay out, what's left for you.
What are the terminologies I want to pay attention to in there? Like, there's a lot of line. If I run a P&L or balance sheet, right? There's so many line items, so many line items. What are these business owners like you would pay attention?
What I coach people to do is to start, especially in a startup or small business, start with cash. All right. That's why, the place to start is your bank account, right? Because it's going to track everything, right? Yes. Your debit card has got more data behind it but when you start to organize that data in a profit and loss statement, what's a profit and loss statement?
Yes.
Okay. Another way to say that is an income statement. Well, now you've confused me. 1 minute you said income, next minute you said loss and profit. Okay, it's real simple, guys. It's sales minus stuff equals what's left for you. So whether you say P&L, profit and loss, income statement, you want to start with a report that shows you how much you sold and how much you paid out and what's left for you.
I see.
Those simple 3 things. Now, it gets more refined.
The initial balance sheet.
We're not even talking about balance sheet yet. All right, why? Because this way of thinking, what you sold, what you paid out, and what's left, you can look at that month by month by month by month. How much did I sell this much? How much did I pay out this much? How much is left for me this month? Okay, start with that. That basic breakdown becomes more refined as you grow. All right, so maybe one day it's what I sold, what I paid out, what's left. Then the next day it's like what I sold, who I had to pay to be able to sell it.
I see. Now you're bringing in people.
Now I'm saying my cost of goods sold, right? Gives me another number that I'll call gross profit. Oh, that's a little bit more refined, right? Okay. When I'm saying gross profit, well, what am I saying? I'm saying that the core earnings capacity of my business is X. I sold $200. I had to spend $100 on Joe, right? I was left with $100. That's my gross profit. Well, what's my margin? 50%. I got a 50% gross margin. Ooh, I'm sounding smart now. Well, then what happens? Well, then I had all this other stuff I had to pay. What do you call that? My operating expenses. Oh, okay. All right. Well, what are those? Well, I had to pay for my, my rent. I had to pay for my equipment lease and my gas and blah, blah, blah. Okay. All right. Now, as I add more of these line items, right, I have another line. I'll call that pre-tax profit, because when I take the gross profit and I take out all this other stuff, now I have what I'm going to get taxed on. Well, that's an interesting number to me. Why? Well, because I'd like to lower that number.
I see.
And all of a sudden, I get really interested in what I can deduct that's going to lower that number long before I have to file my taxes. I'm already planning that, right? And then my net profit, well, what's that? That's the infamous bottom line.
From which now we pay taxes.
Well,
after taxes.
This is after that, all right? But that's really what's left for me.
I see.
All right, I'm very interested in the bottom line because that's what's left for me.
I see.
Sorry, I don't want to hit the microphone, but that's what's left for me.
Yes.
All right, and if there's nothing left for me, what am I doing? Why am I in business? How do I manage all these other things?
Yes.
Now, when I take line item, yeah, it can add up, but those line items all mean something to me. There's somebody I know, it's something I'm paying, it's something I need.
Right.
All right. And I'm balanced that all against the sales, all right? So now when I say income statement, profit and loss, well, that means something, right?
I see.
And like the football field, when I look at it, I'm looking right at the bottom line. And I'm like, that's for me, right? I need to have a number there, right? Or I'm looking at the top, and I'm thinking about all the people I can go sell to.
Right.
Who I need to return their phone call and follow up and be on time and make sure Joe does show up and and month after month after month I can see the whole trend. Am I going up? Am I going down? All right. That's not a balance sheet. A balance sheet we typically say is the snapshot in time, right, of the entire system of values that is my business, the value of my real estate, who I owe, who owes me, what my loan is, how much the accumulated net earnings are. We call that retained earnings, right? When I add all that up, it should balance out, right? And that's a different financial statement, but equally important.
That's why when you're being audited or apply for a credit line, they ask for P&L and balance sheet.
Absolutely, right? P&L is going to tell them, are you earning?
I see. Is your business healthy and profitable?
Is the core thing you do making money or not?
I see. That's the P&L.
That's the P&L, right? The balance sheet is going to tell me, overall, is this business above water or underwater, right?
I see.
Another way to think about a balance sheet is as a personal financial statement. You'll get asked for that too.
Yes.
And those are very easy to think of.
Right?
Yeah, that's like all your stuff that you have, your house, your jewelry, your cars, you add all that up, right? Then if you have loans against that stuff, your credit card, your mortgage loan, you take that number and you subtract it from the assets.
Yes.
And the difference between the two is your net worth. Net worth. Okay. It's the same as equity in a business.
I see.
It's the same calculation. Okay. Why is that important? Well, and this is what I teach my students, like that's either a positive number or it's a negative number, right? If it's a personal financial statement and you just got out of school and you have student loans, it's probably a really big negative number, right? And life goes on. If you're in business and that's a negative number, that could be a problem. We don't want that. Okay. Now there's a lot of reasons that could be a problem, right? Math. The value of your assets went down.
Yes.
Okay. Maybe you weren't able to control that. You owned a building and something happened, the value went down. Now you're so-called underwater, right? The worst reason that could be a negative number is you have more liabilities than you have equity. Okay, that's a problem.
I see.
You are illiquid and insolvent.
I see.
You're not a viable business, right? It's important to people who've been bankers like me because we're going to look at the leverage ratio, which is a fancy way of saying how much debt you have to the net worth. What's the ratio of the total debt to the net worth? If that's over a certain level, we already know you're going in the wrong direction.
I see.
Right. So these financial statements are important because people will calculate ratios on them. You know, even your earnings. If you want to get a loan to buy that car, or truck, or a house, people are going to basically say, well, what's the ratio of your earnings to the loan payment? And if it's not a big enough coverage, we're not going to do the deal.
Understood.
Right?
Understood.
Or even when you are doing, not many banks do it anymore. We used to finance working capital, right?
Yes.
You say, well, you've got assets called receivables. People owe you money.
Right.
And maybe it's a high quality asset from a big company that you're doing cleaning work for.
They're
the
likely
government
going
or
to
something.
pay, right?
Well,
That's
they
what it
might
means.
take 30 or 60 days to pay, but you
Yes.
got to make your payroll. So I'll lend you 80%, you know, of that number in the interim, and then I'll help you collect it, and then we'll pay it off. We used to do a lot of that kind of work in the old days. It's done less these days, but you can do it yourself with a credit card. And the point is, you don't want to get so far ahead of yourself. You don't want to take your working capital money, spend it on a nice dinner on a flight to Paris, right, and then not have the money to actually make the payroll, right? You don't want to do that.
Yes.
All right. So relating these things, you know, liquid to liquid, you know,
Yes.
long term to long term, understanding the purpose, the reason why, knowing that you've got good enough books and bookkeeping to know what the ratios are. That all becomes important. But you take it step by step. Start with a nice, clean bank account.
I see.
Good data.
First one.
Yeah.
So in US, the taxes are generally paid from what's left after you write off the expenses, right?
Yes.
So what are the expenses for a person who's just coming into it? Like, do they write off the lunch? Do they write off the cell phone? Uniforms?
Your faithful tax advisor will allow you to understand, which I'm not doing now.
Yes, that it's not a tax
what
advice.
percentage you can actually deduct because it varies. Okay, but the general concept is that your business expenses are going to lower your taxable income.
I see.
All right. Where this becomes interesting, says the finance guy, is there are some things that are not cash, that don't cost you, not directly, that can be deducted.
Such as?
Depreciation. I could buy a truck of a certain weight and size.
Yes.
You know, I could buy a piece of real estate, or I could do lease and hold improvements on the real estate.
Right.
You know, I could buy equipment.
So now I have an asset.
I have an asset that I can quote unquote depreciate.
I
What
see.
is
And
depreciation? Depreciation is the concept that the value of an asset gets used up, right, as it's deployed, right? So if I bought a car,
Yes.
I might say, well, it has a useful life of X.
Right.
And every year I'm going to reduce the value by a certain amount, right? So the accounting entry becomes that I'm reducing that value, and I'm taking that value out of my profit and loss statement. Does it cost me anything to do that? No.
But then the car needs to be at the business name, not necessarily?
Oh, definitely. The car would be in the business name, right? Or at least accounted for that way for tax purposes,
see.
right? And that's, again, something the tax advisor can...
Right.
But my point is that that non-cash deduction is lowering your taxable income.
I see. From which then you pay taxes in the
You
end.
pay less taxes.
I see.
All right.
And
So
you
when
still
someone says,
have
"I'm
assets.
going to go out and buy, $10,000 of computer equipment,"
Right.
right? And your accountant said, your tax advisor says, "Yeah, let's depreciate it on an accelerated basis as fast as we can." And you get this, whoop, why did I not pay any taxes? I had a net loss carried forward.
Yes.
Well, because we took full depreciation of that computer equipment. That's possible? Yeah, that's possible. Wow. Okay. And again, tax people can advise you on that, but
Right.
those are the kinds of things that make your chart of accounts so complicated.
I see. So it's a wise decision to pay somebody to consult, not like a Facebook group, right?
Oh, no.
Yeah.
No. Look. Why do you want to have books and records and financial stuff? 2 reasons. One, because the first thing when you're starting out that you're going to have to do after you've done some business is file your taxes, right? And it's not just once a year. You might have to do it quarterly, right? All right, so might as well have the people who are doing that paying attention when you have to do the once a year bit, right? Number 2, they're going to set up schedules for things. Maybe that depreciation on that asset you bought takes 5 years. Well, they're going to know exactly how much to take every year. You're not going to want to figure that out, right? So for a few $100, you might save thousands. Why wouldn't you do that? You know, as you go further, you'll want a CPA, right? Why? Well, because if your company grows enough, you're going to want to have a review of your financial statements, a compilation of some kind of those financial statements, or a full-blown audit, all right? And they're going to, in an audit, they're going to take their name, their good name, and put it on your financial statements and say to the world that these statements fairly represent generally accepted accounting principles, right? Which says that a third party has put their insurance and their name on your statements, and that what your statements are saying is true. Well, that's extremely valuable when you're trying to raise money or talk to a bank or bring in a partner, right? All of which are things that, as a cleaner, you might want to do at some point.
Here's a great example. Luckily, I knew how to do the reconciliations and books. In the beginning, I did it, and slowly I started handing off the tasks, and then got the CPA always to file my taxes.
There you go.
And believe it or not, it's the same CPA for 15 plus years.
That's great.
Throughout the years, I was audited. It's not just getting
tax
the money.
audited.
I was not tax audited, but I was audited several times by the state, like employment.
There's employment, there's sales tax, there's all kinds of things.
And each time, because I had records, we were able to come up with a flying flags. Once the state made a mistake and they slapped us with $60,000 fine from nowhere, saying we were back. And I'm like, okay, I call out and I'm like, what's happening? They told us, man, back in 2013, you didn't pay it and it accumulated and it snowballed. Well, luckily, I had the same CPA for 15 years. I went back to him and luckily he had the receipt.
The records, that's right.
And we were paying each month and the next month it was starting from zero. So the very first time when I was talking to this auditor, the auditor says, man, you owe $60,000, but I talked to my supervisor, see if I can cut it for $25,000, $30,000 and close it. I'm like, stop, right? Maybe I owe you nothing. Like I can't make anything. I just calling to find out why I owe you $60,000, right?
You're pointing to consistency, right? Which you had from the beginning. Okay. Very valuable, right? And because there was consistency, there was a record. And your record tied to a third-party system, which was the state system. Right. So when you are using your records to point to their records, it clarifies things very quickly.
So, I mean, it's invaluable, right? What we pay, imagine I wasn't paying that CPA. Imagine I wasn't doing it all, right?
I mean, how much did you save?
60,000.
No, I mean, well, it'd be...
In that instance?
60,000 minus whatever you paid him over all that period of time. You know, it's like you're still way ahead.
Tens of thousands. Tens of thousands, right? Some people who think that like CPA or financial advisors cost arm and a leg, it's actually not, because usually they pay for themselves. And plus, I mean, that's the reason why they exist.
That's why we all exist, you know, like I will help companies raise money, you know, and, you know, what I charge relative to how much I help them raise is like, you know, that's I think the kind of a self-respect thing among finance people is let's just pay for ourselves. You know? It should be a non-issue. You know, but you're onto something, because if you're new in business, that's not obvious on day one. You know,
and you're not gonna get audited on day one.
That's but like, you know, like I was talking earlier about the team, and I was like, I listed 5 different kinds of just finance people. You know, and I think to someone who's starting out in business, they might be thinking to themselves, I don't need all these people. Come on. You know, it's like, you're right. Day one, you don't. But at some point.
Just keep in mind. I like your advice where you said, go get the free checking account. That's free. Go get it. Keep your cash separate and start thinking about it.
Just use a piece of paper. Just
Yes.
Get your psychology
Keep
straight.
it separated.
Yeah.
One of the things about psychology, I see people, cleaners, new ones, and I'm not an exception. So I would charge a person $150, let's say a residential clean, and I would pay somebody $100, and I think I had $50 in my pocket. But then I come to find out there's something that's called overhead expenses. What are they? How to calculate them? Like, why do we even need to calculate them?
Because there's a lot of different ways of looking at costs. Okay. One way, one thing to consider is that we have what you call direct costs.
Yes.
And you have something we call indirect costs. Okay. And there's an entire field of accounting called cost accounting that's dedicated to these things. If anyone who's ever worked in a government contract has been exposed to these things. The government is very aware that there are direct costs and indirect costs. And there's all different kinds of indirect costs. So what's an indirect cost?
Yes.
That's really the question
Yes.
that I hear inside of your question. Because overhead is an indirect cost. Okay? These are costs that you're going to incur that are not part of the direct labor of doing the job. Okay? So,
examples?
Well, there's many. So let's consider. In my earlier example, I said there's sales, and then I said there's cost of sales.
Yes.
So in a labor-driven business, labor is a cost of sales.
Right.
Right? Then I have my gross profit.
Yes.
Then there's all those things that come afterwards, right? There are things that could be called, well, they're like direct costs, but they're just different. They weren't a person, but I had to buy a machine to do that, or a tool to do that specific job. Okay, around some other kind of direct costs. There could be indirect costs that are for benefits, right? Well, if you don't have your benefits and you can't be seen, if you got sick or got hurt on the job,
right?
And the business has that cost. Is it directly related to a specific job or a specific client? No, it's not directly related to that. Is it directly related to Joe getting in the truck and going to? No, it's not.
Right.
Do I have to pay it? Yeah, you do.
I see.
Okay. Maybe you have an office.
Lease.
All right. Yeah. I mean, is that directly related to? No, it's not directly related to anything. But if I don't have the office, I don't have a place to put all the stuff. Right. I've got to have an office, a car,
storage facilities. Right.
Yeah. I mean, there's like and then you might have them in different locations.
Yes.
Right.
Yes.
You might have software.
Yes.
You might have all these other things in addition to professional services or whatever utilities. They're all somehow related to the business's operation.
I see.
I might call it general administrative. I might call it, operating expense, or I might call it, overhead. I might call it fringe or benefits. I mean, there's all different ways to call it, but the fact is it's not direct labor.
I see.
Okay? So the guy who says, hey, I did this $150 job, I paid the guy $100, I'm good, I got $50.
Yes.
No, you don't.
I see.
Okay.
And how to calculate that for a person who's starting out? I mean, let's say I start out from my basement, right? I've got my basement, I've got my car insurance. I pay, let's say, $500 to Google AdWords to get the leads.
Yeah.
Right? I've got a uniform, couple of pens.
Yeah. So again, I'll go back to the simple bank account.
Yeah.
Right. And maybe having a finance person, or at least someone who's really good with spreadsheets.
Yes.
Right. Do what you do for a month or two or three, but no more than 3.
Okay.
Download the information. From your debit card, from your bank account, all right, and look at it.
Okay.
Okay. And you're very quickly going to see, when you go in there, you see, this is the money that came in. They're all positive numbers, all right? Here's all the money that went out.
Yes.
And of the money that went out, there's Joe, there's Frank, there's Susie, all right? That was my
direct
cost. Everything else is probably indirect.
So when I have that total, what do I do now? How do I come up with?
You time bound it and you look at it. So you say, well, I'm just going to look at the stuff that I did in August. Okay, how was August for me?
Yes.
Here's how much came in. This is how I paid the people. Here's how much was left after that, gross profit. Right? And here's all the other things I did just in August. What was left at the end? Okay, this is how much I had for myself at the end of August. Okay, of those things that I paid out below gross profit, what were they? Oh, well, this was the rent and this was the. And you begin to get a picture of the percentage that those costs are for relative to your sales, all right? Then you can say, okay, of these costs over this period of this fiscal quarter, some of them are fixed, some of them are variable. Some of them will go up, like gasoline will go up the more I drive my car,
yes.
all right?
Yes.
But my rent's going to be the same.
Yes.
There's a fixed cost and a variable cost. So I begin to look at my indirect costs as either things that move with more business or that stay the same, right? And I look at the next month, I do the same comparison, and the next month I do the same comparison. Now I have a sense for what it's really costing me, right? So for every dollar that I earn, maybe 30% is an indirect cost, right? So now when someone says, hey, come do this $500 job, I run the ratio based on my history. And I go like, you know what? A chunk of that's got to go to pay the overhead, right? So I already know how much I'm really, or even better, you start to price your work by grossing up. Like I know if I want to have $100 when I'm done, I better charge them $135.
I see.
Right? You change your pricing to cover your overhead. Right?
You can do the same with hourly too. If I was charging,
absolutely,
let's say $20 an hour, now I charge $26 an hour.
That's right, and you know every hour you've covered more overhead.
I see.
All right.
Understood.
And you also know what your thresholds are, like because you got to cover all the fixed costs. If you did nothing, you'll still have fixed costs, right? If you do a lot, you're going to have fixed costs plus a higher percentage of variable costs, right? But when you stop and you actually do a little math, looking at the numbers, or work with someone who can help you do that,
yes.
Now you have a clearer expectation when you're negotiating the next deal.
I see.
Or when you're paying out the next person.
Understood. And now it's covered as well. The overhead is covered.
You can start to plan to cover it. Yes.
I see.
Yeah.
Okay.
Yeah. So you know in your pricing you've already covered it. It gives you more confidence.
Is there any technology we can use that can start helping us with the books, the overhead? Any tools that you would recommend? Or commonly see used, not necessarily recommend?
You got me on that one. Everybody uses QuickBooks. That's nice.
Okay.
There's a lot of other accounting packages out there. I'm a little hesitant on all of them because most of them overwhelm an entrepreneur who's working on their own unless they want to stop and become an accounting guru. So I think having a simple way to look at a few things is more powerful than having a big robust system with 1,000 whistles and bells that you don't know how to use. You know,
so spreadsheet can do it.
Yeah, if you can use a spreadsheet. A lot of people I work with don't use spreadsheets.
I see.
Right? Why? Well, because you got to type formulas. You know, like if you're someone who can do that, then absolutely you want to grab your bank data, download it as a CSV, pop it in the spreadsheet, and run your analysis. It takes you 3 seconds.
I see.
Right? If that's not you, then print it out and do it by hand. You know, but you want to start to get a reflex. Like, you know, what's the ratio of your operating costs? You know, because if you don't know that, you're going to make bad prices. And you're going to pay out too much and not have enough to pay your bills.
Right, right. That's what I see startup cleaning companies do that, and owners too. And I wasn't the exception.
Startup is hard because you don't have data.
Correct.
You have to guess.
And the experience, right?
Yeah.
You don't even know what overhead is, right? Like
that's so true. By the way, ditto for me. You know, I wasn't in the, when I started, my first business was economic development consulting. Sounds fancy, but I was basically a consultant, right?
Yes.
And I'll tell you a funny story.
Yes.
I went out and I decided how much money I wanted to make.
Yes.
And I divided that up by the number of hours in a year. And I said, that's my price. And I got no business. I didn't know. And I said, geez, I gotta get some business. I can't just, this is awful. And then I realized I had to do all these things. I had to do my accounting, I had to do my marketing, I had to and I said, you know, I wonder how much time I'm actually spending doing all this stuff. Right? So I had an experiment for 1 month, and I was a young guy at this time. I tracked every hour, everything I did. Slept, you know, ate.
How long? For how long?
For 1 month I did this. It was insane. I did it for 1 month, but I learned something.
With pen and paper?
I was using a little program that I had to track my hours. You know, I could click it on and off, right?
Okay.
But what it taught me was that I had to recuperate the time that I couldn't bill directly for, the indirect costs. Okay? So then I got smart and I grossed up my rate by the percentage of my indirect cost, right? And I took my higher rates out to my clients, and I had more business than I could handle. And so I asked 2 of my new clients, I talked to you before you wouldn't hire me.
Yes.
Why are you hiring me now? It costs more. And you know what they told me?
What?
They said, we saw your pricing and we knew you didn't know what you were doing.
Oh, I see. I've seen that in a bidding environment. Somebody gets the proposal, they're like, usually 10, they get the expensive throwaway, they get the lowest throwaway. But if it's lowest is unreasonable, they don't even like, that's just great.
That's it.
And then they get like 2 or 3 qualified lowest bidders, and then they entertain them. I see. So they knew based on your numbers that you did not know.
Yeah.
They
knew this guy's not covering his costs. He can't be sustainable.
I see.
I was good. I figured it out fast enough to go still get some business and pay my bills, right? But that was my first encounter with indirect expenses.
I see.
You know, and then I realized that the whole market is grossing up their rates, because then I was competitive. The whole market knows to do this.
Yes.
You know, so it's no different in the cleaning business.
So for cleaners.
Yeah.
Advice for them if they're struggling. What would you recommend? Like if somebody didn't know about the overhead and now they are liabilities more than their assets. Now they're payables more than their assets.
Oh, so they're already in trouble.
Yes.
Okay.
If they are already in trouble, are there actionable steps they can do? What helps them? Like, you know, they have a student debt, they had whatever the mortgage, they're not making enough. They don't know whether to close the credit card payment or whatnot, or about to file a bankruptcy.
Oh, don't do that.
What is the actionable step that where they can start seeing quickest results?
I'm glad you asked that, because, you know, if you're in trouble, so a big part of my business is advising and coaching and supporting entrepreneurs, right? Because it's great to talk all the finance stuff.
Yes.
But if your heart is broken and your mind is fogged, you're not going to do a lot of business. We got to get you into a healthy psychological, emotional place, so you can take action.
Yes.
Right? So that's thing one. To be self-aware enough to know if you are in crisis, right? A lot of this work is energetic, which sounds a little woo-woo from a finance guy.
Yeah, from a numbers guy, right?
Yeah, but it is. You know, no one's going to do business with someone who's in panic mode.
Yes.
No one's going to do business if you are depressed or you're down or you're in survival mode, and you're going to wonder, why can't I get any business? It's because your vibe, man, is so weird. Why would we give you our money? No. People want to do business with someone who's confident, someone who's got their stuff together, who takes, you know, proper control, who delivers on time, you know. So you got to get yourself in a good space, right? And so you might work with someone who can help you do that. The next thing is to get good data, right? You're probably in crisis because you either didn't have good data or aren't present to data, okay? Why? Because let's go back to the profit and loss statement, right? If you have not looked at it, then that's a place to start, right? If you have looked at it, then there's some simple questions. Are you profitable at the gross profit level? If you're not, you have a fundamental business problem. It's costing you more to do your business than you can earn, all right? How do you solve that? You raise the price or you lower the cost of goods sold. Well, I can't pay Joe less. Well, then you got to raise your prices.
I see.
All right, now we can go to work on that. All right, maybe you're profitable at the gross profit level. Well, let's look at all these other expenses, something I do a lot of with entrepreneurs. Do we really need this? Can we substitute that? Can we delay this? You know, like what, you know, let's actually get the I don't want to use jargon. Let's get the general and administrative. Let's get the operating expenses. Let's get the fixed and variable into the right proportion, right? Against that gross profit. So there's something at the bottom, right? That means the relationships that are connected to all those line items need to be looked at, right? And if you got your head in the sand, you're not looking at them, because look. I tell people, my students when I'm teaching, you know, accounting is accounting for what people do. That's all it is. It's not some magical number thing. It's just a shorthand to track what people do. All right. Another way to use that word is accountability. All right. In some languages, that's the word. All right. So we're holding ourselves and others to account through this practice. Okay. As the business owner and lead entrepreneur, that's your job. Okay. You need to know you are accountable for sales. You're accountable for the core earnings of the company. Let's make sure it's a positive number. Then you're accountable for all the relationships, whether it's your auto loan, your mortgage, the BG&E, whatever it is, you're accountable for that. So let's get in communication with all these people and manage that into the right space, right? Then we can look at the balance sheet and say, okay, too much debt, let's negotiate that. Oh, we need a different kind of asset base. We need to, you know, boost the earnings in a different way, you know.
Remind me of a personal story, not mine, but my close friends.
Yeah.
That's more like personal, not the business, but the guy found himself in debt. He had a lot more payables, credit cards, mortgage, wife's student debt, the home that was coming in, and their lifestyle. So the way he was able to get out of it, he got on a Dave Ramsey show.
Oh, I love Dave Ramsey. He's great. Dave hates debt.
He does, right? So I mean,
he totally hates
there's
debt.
content pros to it, but that plus any other knowledge and action he took helped him out. So one of the things he did is, instead of, you know how people think, hey, let's say my home mortgage is 3%, but my credit card mortgage is 12%. But so whatever there's a different interest, right?
Yeah.
So they try to, in general, we naturally try to pay off the largest debt. So what he told me and what he did is, instead of going for that, he started paying off the smallest debt, getting like quick win.
Then Dave calls that the snowball.
And then the freed up money that he had, now he started putting on a big debt.
Yeah.
Because
Dave calls
he
that
freed
the
up.
snowball. It works. That works. But that person, as you're describing it, had kind of violated Hakim's rule number 1.
Which is?
Segregate the funds. You need to know the level of performance of the business, because that's what's ultimately paying the bills.
Right, what you were saying.
Well, business versus personal.
Yes.
Right? Like, that allows you to reframe the conversation. Right? Remember, the psychology is important, right? So if the problem is the business isn't earning enough, I have to take a different action than if the problem is I'm not paying myself enough. Well, why? Because my wife's student loans. Well, your wife's student loans are not a business expense. They're a family expense.
Understood, yes.
So are you paying yourself enough to cover your family stuff, right? Because maybe the business is actually earning just fine. You just paid everyone else and not yourself. Well, okay, different problem.
Yes.
You know, why am I going to beat up all my people working in the field to pay my wife's loan when I just need to pay myself more? Which means maybe I cut some other expenses. Maybe I do add more revenue. I don't know. Or maybe I go to work at the gross profit level.
Yes.
Right? So the sooner you get those things separated, the sooner you can have clear conversations about them.
Understood.
Right?
Understood. Wonderful. Well, super thankful for you being here.
Oh, it's my pleasure.
How can people get a hold of you, and how can you help?
Well, there's a number of ways that I can help people.
Yes.
One, I'm always happy to do a business assessment.
Okay.
If people want to figure out what they should go to work on, that's really easy. I actually would be happy to do it in groups too.
Okay.
You know, so that if people think, well, I don't want to be the only one, like maybe we put together a group of people.
And break down the expense too. It helps with the expense.
Well, I'll walk them through some of the concepts that I work with to help them get on the same page.
Okay.
In terms of how they think about managing not just the profit, but the overall picture of their business. And sometimes it's more fun to do it in a group, right?
I see.
And then if people really want to, go to work, this is what I do. I work with people to raise money, have them earn more, and have them keep everything clean so that it's clear that the business has a voice.
Yes.
And hopefully that voice and those earnings support their family life as well. If I'm not helping people achieve their dreams, then I've got no reason for being. I exist so that people, that entrepreneurs, can achieve what they're called to achieve in this world.
I see.
And, I have found enormous inspiration in what people are out to achieve. They might want to get a kid through college.
Yes.
They might want to buy that first house.
Yeah.
And I've been blessed in my finance career to have helped people do that. I've sat at the dinner table with people who never thought they'd own a house. That's what I live, you know. So.
And we're gonna leave all the contact information for you in the show notes.
That's great.
Thank you so much.
Very good. Thank you, sir.
Yep.